Good morning, guys, and welcome to the show. Today is Monday, the 4th of June, 2018, and we're going to get the chart started right here. Okay, we're going to start with the silver price today. Silver price has been what I would call dipsy-doodling. That means it's been going up and down, you know, but it's still staying in its range, and it's still in the lower range. The lower range is like from 1620 to like 1650, along in there. The higher range is from like 1680 to like 1720. That's the higher range. So it's been in the lower range for a long time now. It could move up into the higher range and still not break out. I know an awful lot of people have been waiting for it to break out so long that when they see it moving into the higher range, say up to 1720, they get all excited and say, this is it, this is the breakout, silver's to the moon, everything else, you know. But no, not yet. Not until the fear actually hits do I really expect a breakout. And believe me, the fear is coming. Now, let's take a look at Bitcoin. Let's go to Bitstamp. Right here, $7,499. Bitcoin's holding kind of steady, really. It was up to 77.05 earlier. Let's go to the 15-minute here. There, 77.90 actually it peaked at earlier. Let's see, what time was that? About 3:30 in the morning, I guess. Now it's meandering, it's on its way down. It's actually having a hard time staying up above $6,900 or $69.90 or whatever, you know, moving down to the 6,000s. It's having a hard time. It's fighting. It's struggling to stay up in the 7,000s right now, to be honest. Dow Jones stock market. No, wait. First, we got to do cryptocurrency market capitalizations. We are looking at roughly all the coins being somewhat down today. A certain percentage. I see red everywhere except for Tether. Tether's the only coin, but it's only marginally in the green. Everything's red. All the numbers are red today. Let's see some of the bigger ones. The bigger moves down. EOS is really down today at $13.64. Now, when a coin is really down, the price is down, that's when to buy it. Litecoin is down 4.96% at $120.40. IOTA is $1.74. Ripple 65 cents. Bitcoin Cash is $1,119. The biggest one down I see is IOTA. IOTA is down over 12% on the day at $1.74. That's looking good, boys. Looking good. EOS is down, way down too, at over 9% down at $13.64. Good coins right there. Now, let's take a look at the Dow Jones now. It's up 192 points on the day. It's riding between a range of around 26,000 and 23,000. And it's been doing that for a while now. It's been floating between that range, just basically going sideways. And it's going to continue to do that until the bond market goes over, the 10-year goes over 3.25%. Now, you're probably asking, when is the 10-year going over 3.25%? And we're off to take a look at the bond prices. Now, we're going to examine the 10-year right now, and we're going to take a closer look at the U.S. 10-year, as that's what we're interested in right now. And we're looking at the one-year chart, but we're going to move to the 6-month chart here. Okay, and we're going to move forward in the 6-month chart. Now, we're going to close in on the chart so you can see what we're looking at here. Pull in. By the way, the yields are up today a little bit, but that's not what we're really concerned with. We're really concerned with this right here. The yields went up to 3.1%. And then what happened was we seen this dramatic fall all the way down to a bottom of around 2.75, I guess, somewhere around in there. So I guess somewhere around 2.75 or so. And anyway, what's happened is now you see them yields starting to shoot back up again. And they're now up to 2.92% right now as we speak and climbing. Now, this was an awful lot of buying, bond buying. And what caused it was the fact that everyone has been chasing yield for a long time now. And they're in that mentality of chasing yield. The stock market right now, the yield in the stock market right now is being surpassed by, once the bond market gets over 3%, the bonds actually have a better yield than the stock market. The stock market yield is in the twos, someplace in the twos. I can't tell you exactly what it is, but somewhere in the twos. So if you're chasing yield, you want to get the best yield in what you consider a safe, secure asset. And bonds are the place to pile into, and that's where they're piling into money. Money's piling into bonds, you know. And so what you see, this fall right here from 3.1%, this fall down right here to this 2.75, was a tremendous amount of purchases in the bond market, and they're driving yields down. But these buyers, you know, are one-time shot. It's like you when you're going to go out and buy a car, you know. You go out and you buy your new car and you get it home. You're not going to go out and buy another new car. You've done it. You've shot it. You've blown the wad of money that you got, and it's gone now. And so you've spent it. Well, that's the way with this bond yield's fallen from 3.1% all the way down to 2.7 something percent. That was a tremendous amount of money. That was a big purchase. It's gone now. It's done now. But what's happening is we see the bond yields starting to rise back up again. They're not going to come back in such big numbers if they do come back in next time to drive the yields down as much next time. But by them doing that, they're making the Fed think they're going to get away with this crap. Simply put. What I call crap is the Fed's program of trying to sell their toxic balance sheet. They're getting away with it right now, so far initially, up till now, more or less. Okay, the stock markets fell back a little bit, but that's within what they figured might happen. And so right now they're sitting back, they're happy, and they think they're getting away with all this. But what they don't realize is pressure is building within the structure of the system. And that pressure is going to explode rather suddenly. It's something like a steam pressure cooker, you know. It's got a little nozzle on the top, and it goes pss, 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 and the steam comes out, and that's fine. If you put something on top of that nozzle, or you block that little thing, you're going to get an explosion. And that's what's happening. This whole system is blocked. The Fed is trapped. Okay, so now let's move to the dollar index. 93.85. We're seeing it move down toward my intermediate target of 91. That's been my target all along, 91. But later it's going to go back up, but only after the crisis begins. The dollar index. So the dollar index is down just a little bit right now. It's down 0.34. It was up in the 94s. Now it's down to 93.85. It doesn't surprise me really any. Okay, so now let's take a look at this guy. We've went over to zero hedge, and this guy right here, Bill Dudley, okay? He's evidently left the Fed, so now once he's left the Fed, he doesn't have to lie anymore. He can tell the truth. And so what's he got to say? You know? What's Bill Dudley got to say? He says, he proclaims, he says, no one could have saw that coming. He's talking about what happened, I guess, in 2008. No one could have saw that coming. Well, yes, there are people out there who saw that coming. A number of economists saw it coming, but they don't pay any attention to them. They're only interested in themselves and their academic friends that work with them, and they don't pay any attention to the other economists, that actually can see stuff like this coming. So he says no one could have saw that coming. It's a defense to explain the Fed's inability to comprehend the massive bubble they had created, which led to the curtain being pulled back from the Emerald City, that is the Eccles building, during the great financial crisis, because such an event was not even a possibility in their myopic and now clearly proven useless academic rigorous models. They're academically rigorous models. And so what these guys do is they have a lot of models that they use. One of the models that they use, the Phillips curve and everything. These are academics, these people, and they go by these models. They live and die by these models. And when these models are actually proven useless, they go back to, we don't understand. Nobody could have saw that coming, and they start to make statements like that. It says, and then Dudley admits that in their attempt to rescue the world from the fates worse than death, global deflationary credit collapse that happened in 2008, and the unveiling of where asset values really lie, the Fed has lost control of its transmission mechanism through the interest rate channel and has created a monster. And this is exactly where we are today. They created a monster in 2008. They never really stopped the crisis. What they've done is they've thrown money at it, and now they're withdrawing the liquidity has been kept things rolling along till now from 2008. The system actually died in 2008. It's been on life support. Now they're pulling the life support away, and they're expecting the system to live on its own. No. You pull life support away, the system is going to die. And right now, it hasn't died quite yet, but it's getting ready to die suddenly. And this is where I come in. This is where I realize what's going on and what's happening. And it's all tied in to, if you want to know when it's going to happen, keep your eye on the U.S. 10-year. Watch when it passes 3.25%. And now, I've been talking about it passing 3.25% for quite a little while now, but we've had quite a few bond buyers coming in. And like I say, they have driven the yields down again. But the yields are starting to creep back up, and at the end of this month, the Fed's going to increase it by another $10 billion, so they're going to increase the net effect. We're going to see these yields pop. That's what we're going to see. Probably not this month, probably next month. We're going to see the yields pop. We're going to finally see the yields, I think, go over 3.25%. And that doesn't mean we're going to instantaneously get a market crash when they go over 3.25%. It just means it's ready for the market crash. So then we read on a little bit more here. It says, and then a flourish of typical academic arrogance. Dudley points out how crucial it is to use financial market prices and indicators to inform policy decisions, clearly missing the reflective impact that the Fed policy has on those very same market indicators. Just how well did the repressed and conditional collapse of the global volatility inform policy as February so rudely sparked the biggest tightening of financial conditions in history with no apparent warnings whatsoever? So anyway, this is where we are with this. We've got these academics, and they're actually pulling the strings and controlling things. And they got one tool. That's a money creation tool. Now, for anyone out there that believes that they're not going to use that tool when the system starts to crash, you're absolutely wrong. They're going to use that tool as hard as and as much as they need to use that tool to so-called save the system and kick the can down the road. And that's the difference between the people who believe in deflation and the people who believe in inflation. Because if they didn't use this tool, we would have the Great Deflation. For anybody out there that believes they're not going to use the tool, you're mistaken. They're going to use the tool, and that's why we're going to have hyperinflation instead. So listen, thank you guys for listening to this market report. We'll catch you tomorrow, and bye-bye, guys.